Welcome to the Genus quarterly video. It's October 21st, 2019, Election Day. Big day. But before we get to that, I just want to take a step back and say we have been holding seminars, as we do every fall, different locations, and we've had about 5 or 6 of them. And in every location, the first question is, how do you tune out the noise when it comes time to making investment decisions? Noise like war in Syria, Brexit, impeachment, you name it. How does Genus tune that out, or do you tune that out when you make investment decisions?
Well, first thing I do is I close my office door, and then I turn the TV off and look at the data and look at the fundamentals. And that's what's driving our position. And we look at 6 different factors, or groups of factors that look at the economy, look at liquidity, look at risk, and that helps us make decisions. And at the end of the day, you've got to focus on the fundamentals. And ultimately, if there's something wild and crazy out there that's happening, it'll drive those 6 different factors. So that's what we do. We do that diligently every single month.
And in these seminars, we were able to boil down our view of where we are in the economic cycle as still going into the valley, not sure where the bottom is. And maybe just touch on some of the reasons why we think that.
Well, we're having a slowdown right now, and the soft data, the consensus, the corporate consensus numbers are soft, they're weak, they've been slowing down now for about 18 months, and they're getting weaker over the next probably 6 months. That usually leads the hard data, the GDP numbers, the industrial numbers. And so we're getting a slowdown. It's going to probably bottom sometime in Q1, I think.
And in our seminars, our main pieces of evidence for the slowdown was slowing money supply growth.
Money supply growth is slowed down. And I'm talking about the money supply that was actually, rates rose into last year. That's having a negative impact on money supply. And so we're still living under the monetary regime of last year. And so over the next 6 months, whatever the Fed does right now is not going to have an impact on the next 6 months. The cake has been baked, and so we're going to go into a slowdown. Hopefully the trade war issues will be positive. I don't think they're that much of a big factor right now based on the next 6 months.
So just to summarize, when the Fed increased interest rates a year ago, that slowed down 2019, and the declines recently in the Fed interest rates won't impact it
for another year almost.
In
terms of the economy. So
we're lagging the movement of the Fed.
So the Fed's work has already been done, and we'll have to sit and watch and see what happens.
See how far down we go.
Yeah, and typically when you get these slowdowns, something gets broken. There's some financial accidents along the way. We've seen WeWorks kind of blow up here recently. There's concerns about that.
You're getting ahead of one of my questions. We've been saying all along, this is the most dangerous part of the economic cycle. Yeah. It's more dangerous than when you're knowingly in a recession. So why is that? Why is this more dangerous?
Well, usually what happens during these slowdowns is the excesses get squeezed out of the system. And whether it's negative bond rates in Europe, for example, in Japan, that come back and hurt somebody, hurt a bank, hurt a broker, hurt a crazy IPO.
And isn't it often excess debt that we're not really aware of that hits somebody?
That's usually often what happens too, and you usually look at the most. I still say that the mispricing of the government bond market is the biggest issue out there, and how that's going to impact somebody when that normalizes. So that's a concern. Right. But that it often comes out of left field where you don't even expect it.
Right.
But accidents do happen, and that's our concern. And usually an accident happens before the bottom. Usually an accident drives us to a bottom somewhere, and typically it's a place where once the economy slows down. All the over excesses come out, whether it's too much debt, whether it's a bad business model, they all come out. And so something's probably will happen, maybe in the IPO market, maybe
and something may not happen.
Yeah.
We're not calling for an accident to happen. We're just saying this is the dangerous time if it does happen. So Wayne, we've talked about how you close the door and turn off the noise, but surely the Canadian election's a little different. It's a little closer to home. It's probably not totally noised. It's real information. Canada is very divided. After looking at the rest of the world, pointing fingers and all different tribes around the world, it seems Canada, Alberta, Quebec, Toronto, everybody's doing the same thing here. The Greens in Vancouver Island. So what implications does that have to the Genus investment strategy?
Well, number one,
Now, we don't know the election results yet. It's
yeah,
the middle of
but
the day.
just looking
but
at where
looking at the polls.
it's going to end up. I think or today is going to be, the results today are going to be one of two things. It's either going to be a Liberal minority with a coalition with the NDP, or it's going to be a Conservative majority, and that's not going to happen. So it's probably going to be a Liberal NDP government, and that's going to be, so basically what's going to happen is the NDP are going to be calling the shots, and I think that's worse than a Liberal majority. So I think it's going to exacerbate the issue with Alberta, and I think Alberta is going to have a referendum probably on equalization payments, just to prime the pump for a potential referendum down the road, and that's not good for Canada. Any sort of sign of referendum.
And the Bloc's doing very well in Quebec.
Bloc's doing very well in Quebec as well. So any kind of sign of referendum in Alberta would be trouble for our capital markets. You'll see volatility. You'll see probably provincial spreads get blown out.
And currency.
And currency probably weakness as well, and volatility. And so that's a concern. And I think you'll see people start moving some of their money out of Canada. So I think it's an issue that we have to be aware of and on top of.
What response can Genus have?
Well, I'd say number one is the area that's going to probably get most affected for Canadian investors would be our fixed income markets. And there's a broad, deep market south of the border. I think covering some of your fixed income exposure into the US would make a lot of sense if you're concerned about this kind of volatility in the future of Canada.
So our clients will be concerned about that, and so we're looking for a solution.
We have some solutions on the board right now. We're looking at different options for getting our clients more US exposure. It'll be within the fixed income component. We might downgrade our Canadian equity exposure as well, but the fixed income is going to be our number one priority right now.
So not an uplifting day for us Canadians.
Yeah, it's the House is divided.
Yes.
And we either need a new deal, and hopefully not a separation. I'm not expecting separation, but the talk and threat of a referendum.
Right.
We know what happened during the Quebec crisis, and Quebec sort of set the table for this all. We all know it's 50% plus one. Right. So they've done all the heavy lifting, if you will, which would make it easier for Alberta to disengage. So it's something we have to be aware of, and it's an economic issue for Alberta, and we're going to be watching it very closely.
It's so interesting. The world has become so divided within countries, and Canada's been watching this for the last 5 or 6 years, and now it's come home to roost. It's happening here too. I think maybe it's a good idea now to remind our clients that we've got defensive in your portfolios in August of 2018. So just over a year ago, our models went negative. We saw a slowdown coming, and we went to big defensive posture on the equity side, lots of high dividend global stocks. And on the fixed income side, more cash than we much normally have, about 10% cash, which is a large weighting. So if there is any kind of accidents, we are ready to be buyers. We won't be surprised. And if there are no accidents, which hopefully is the case, we'll be participating. For example, in 2019, year to date, our clients are up about 7.5%, despite being in a very defensive position. So that's going to be, for at least the next quarter, how we'll be approaching things. And stay tuned for how we're going to address getting more US fixed income in the portfolios. So Wayne, we talk about this being the most dangerous part of the economic cycle. So when do you think the coast is clear? When do you think we know that most likely no accidents for this cycle?
Well, I say number one would be time to get through the next 3 to 6 months at least. And we watch liquidity, money supply, some of the risk measures, and the internal dynamics of the market. But the cavalry is about to come over the hill. If we can get into the second quarter of next year, year-over-year money supply growth will be probably up around 7-8%. If it's there, that's not a bad sign in terms of growth, and that's where the 2008 market took off, when it saw that kind of a sign of liquidity growth. So we're going into the valley right now, but we're starting to see the other side of it. But we have to go through the valley. We just can't fly over it, unfortunately. But there is hope on the other side if we can get through here without any accidents, and hopefully we'll get through into 2021 before any kind of a recession.
We welcome your phone calls. It's time to stay close to our clients and be sure that we're reflecting your needs and your portfolio. So please give us a call, and we look forward to chatting, and we'll see you next time.